everyone, my name is Quadra. For today's video, what we're going to be looking is about investment and retirement. What are they and how do we look deeper into each of them? So first, let's look at saving and investing. For the first look, we are going to be looking at about um, saving and investing. So these are really important concepts that I believe everybody would need. So you might have heard the terms of saving, investing, and use interchangeably. Like saving for retirement when actually you're investing in a 401k. Although they're related, saving and investing are different ways to achieve your financial goals. So savings mean putting money aside for future use. For example, you might save money by keeping it in a bank account where it remains safe and earns a little bit of interest. Some common reasons to save include like having money for emergencies, short-term goals like a new phone, or even long-term goals like buying a car or going to college. So investing, on the other hand, means putting money into assets that can grow in value over time. Examples in investment options include real estate, stocks, bonds, and mutual funds. By investing, you hope that the money you put in will grow and be worth more in the future. Investing can help you achieve long-term goals like home ownership or retirement. So there's a lot of saving and investing options such as bank account, a safe place to store your money and you can often earn a small amount of interest. You could save in certificates of deposits, which is the type of saving accounts that usually will earn higher interest than a regular saving account, but requires you to leave your money to untouched for a set of period. So stocks are buying shares in a company, making you a part of owners. You can make money if your company's value goes up, but you can also lose money if the company's value goes down. Bonds is lending money to a company or government who promises to pay you back with interest. And multiple funds is a pool of money for many investors that is used to buy a diverse mix of stocks, bonds, or other investment. So whether deciding when deciding whether to save or interest, it is essential to consider factors like liquidity, risk, return, and time horizon. First, liquidity refers to how easily you can access your money. Saving accounts have high liquidity as you can withdraw your money anytime. Investment, however, might not be easy to sell and convert to cash. Risk is the potential for your money to lose value. Saving in a bank account is generally low risk, while investing in stocks or bonds has a higher risk, and as the value can go up and down. Return is the amount of money you gain or lose on your investment. Saving accounts typically have low returns, while investment like stocks and bonds have the potential, just the potential, for high returns. Time horizon is how long you plan to keep your money invested or saved. Well, if you have a long time before you need the money, investing can help your money grow a lot more. So, how to start saving, how saving and investing can work together. So, saving and investing can complement each other in helping you achieve your financial goals. For example, you might save money for emergencies like short term goals, while investing for long term goals like retirement. By having both savings and investment, you can ensure that you have the money available for intimate needs or also future growing in the future. So these are the biggest tips that I think everybody will need to have when they are moving with saving and investing. So let's look at risk and return when we're investing. So when you decide to invest your money, there are two important things to consider, which are risk and return. Risk is the uncertainty or variety of some of the outcomes of an investment. So in simpler words, it means that there's a chance in your investment may not make as much money as you hope, or you could even lose some or all of your investment. Return is the gain or loss from an investment over a period of time. It tells how much money you made, how much money you lost on your investment. If you have a positive returns, that means your investment have made money. If your return is negative, then you've lost money. So investment is pretty much of risky, but how can I tell how risky an investment is? So first, we look at the low risk and low return investment. Treasury bills are an example of this type of investment. They're issued by the government and are considered very, very low risk, but they also offer lower returns compared to other risk. High risk, high return. Penny stocks are an example of this type of investment. These are stocks of small companies that can trade at a very low prices. They can offer huge return if the company does well, but they can also carry a higher risk of loss. Moderate risk and moderate return investment is the perfect type of invest for a lot of people. These are funds that aim to match the perfect of a specific market index, and they offer a diversification and generally have a lower risk than individual stocks. So, um, there's a lot of way to calculate one thing, which is return on investment. Imagine if you have $100 to invest in something, you know that you made a good choice. You can turn that $100 into even more money. This is where ROI, or return on investment, comes in. Well, ROI helps you to figure out how much money you've made from an investment compared to how much you've put in. So you're invested your $100 and return to $150. Well, your ROI would be 50%. That means you made 50% more money than you started with, which is a really good thing. So a lot of the time you can find the ROI for different investment online, so you don't have to do any math. But usually you would need to look at some functions to recheck. But sometimes you can't find the ROI on the internet, or you're starting or your own business. So in this case, it's important to calculate ROI in your own. So why is the rule of 72 important? So first, let's look at what it is. For this, you need the rule of 72. The rule of 72 is a simple math formula that helps us estimate how long it would take our money to double when we invest it. And so, for example, if we invest our money and earn an interest rate of 6%, we would do this 72 divided by 6 equal 12 years. So it would take about 12 years for our money to double. So it is really helpful because it shows us the power in investing and how our money can grow over time. So this is a really, really important thing. In conclusion, investing and savings are both really important things so that you could keep your financial goal in a realistic way, and so that you could actually reach it in the time that you want. So make sure that you know about the ROI and the 72 rule in investment so that you could actually dive deeper into investing and all. Thank you so much for listening, and goodbye. See you on the next video.